We should also add shares of Nike, which are lower after missing on earnings estimates, beating on revenues, boosted by strong demand in both the U.S. and China, despite the ongoing trade tensions between those two countries. CFO Andy Campion downplayed the trade risks on the call last night. He got a question about whether they were seeing a decline in Chinese spending. Listen.
We have not seen any impact on our business to date, and we continue to see strong momentum as we enter fiscal year 20.
Joining us now is Bob Drbul, retail analyst at Guggenheim Securities. This was one of the biggest question marks, I think, going into the earnings report. Yeah. What would China look like? 22% growth and no impact from a trade war. How surprising is that for a company like Nike?
Well, I mean, I think they've proven over the years their ability to, be quite agile and flexible in terms of any global environment. I think it was definitely a concern, and I think they did more than really address what those concerns were in terms of their outlook and their performance.
Did they address, though, what would happen if things don't go well at G20 and the next batch of tariffs go through? I didn't get any really quantification or exposure type numbers.
Well, I think when you think about their supply chain, I think the first thing I would say is part of the miss was an investment in supply chain, and they're continuing to, look longer term versus near term. And when you think about their ability to navigate global sourcing and their ability to source in China and maybe ship to China and maybe source from Vietnam and ship to the U.S., I think they can manage through it pretty well over the near term and even over the longer term. I think they've proven that over the last 20 years that we've been covering this name.
I mean, the shares are down. I think the big EPS miss was pretty much chalked up to the fact that costs rose 10%. They're spending on direct-to-consumer. They're spending on digital. And we know they spend big on athletes and celebrities and World Cups and that sort of thing. So what's got investors concerned?
I mean, I think that's a piece of it. This was the first miss in many years on an EPS basis. But I think when you look at the other metrics and you look at the global revenue growth, double-digit constant currency, the sustainability of the U.S. plus 7%, the 22% in China, inventories are in a great position. I just think this is a company that, if there's a company to ever give a pass on 3 cents, I think this is it. And the other point that I would add is foreign exchange for the whole fiscal year was a 15-cent hit. And so when you think about how they plan their business over the longer term, they're going to move forward and keep their head down and keep really pressing, and they're not going to let the strength of the dollar really impact how they view the longer term positioning of the company.
Sarah, were you surprised the extent with which they played down the trade war risk? This is a company with exposure on the demand side, on the supply side, and we've had plenty of those trade representatives who make sneakers come on and say that this is the worst thing they've ever faced.
So I think it's a good example of a company where every macro risk in the book is being thrown at them. Global slowdown, foreign exchange costing them $1 billion, China trade risks. And yet, if you make products consumers want and charge more for them, like the Vapor Max, which is killing it, all the Air Max iterations right now, Jordan, especially for women, has been revamped, then people will just pay. And I think there was a strong statement at the top of the call from Mark Parker, the CEO, saying, we are a brand for China. And that was a clear signal that they are going to double, triple down on the Chinese market and that they are working their sources there to make sure that this kind of growth continues.